Now we have an EBIT of, call it, $5 million principal payments only on their equity. So 0% interest, right? There's like 75 million businesses that are looking to be transacted in the next 3 to 5 years or getting paid to buy real estate.
334 hotel rooms converted into 341 studio apartments. Distressed hospitality turned into workforce housing. Underutilized retail and office repositioned into cash flowing assets. With over 20 years in real estate between being an agent, an investor, and a developer, today we're talking to Steven Glaude. He is a real estate operator known for building value through adaptive reuse and creative execution. Steven, welcome to Capital Conversations.
What's going on, AJ? Long time no see.
Long time no see. Thanks for being here. And before we continue, is it Glaude or how do you say it?
It's actually Glaude, but it is a French last name and has different pronunciations, but I'll go with either as long as you don't call me late for lunch.
All right. Steven Glaude.
Yes,
Thank
sir.
you for being here. Tell us about your portfolio. What you got going on right now?
Well, as you mentioned, I've been in real estate for the better part of 2.5 decades. I'm a licensed agent here in California. Started off as a retail agent, like most, I think, investors do. They kind of dip their toes into real estate by helping buyers and sellers on the residential retail side of the house. And then you start to see investors coming in, looking at potential opportunities for fix and flips. And I'm like, wait a minute, I could do that. And so I started flipping some houses. At that time, I was also double dipping in kind of a W-2 on the AT&T telecommunications side of the house. So Corporate USA, Pacific Bell, SBC Communications, AT&T for the better part of, say, 17 years. And real estate always being my passion. I was double dipping as a licensed agent, working full-time with telecommunications, and then moved into real estate full-time about, I want to say 7 years ago. But in order to do so, realizing it's probably a good thing to have some consistent income. So started a Airbnb arbitrage business before it became a thing. So for those who are not familiar with that, basically taking a rental property from a landlord and then subletting it on Airbnb for 2 or 3 times more than what I was paying the landlord their rental income. Transition from fixing and flipping houses to running an Airbnb arbitrage business, not necessarily realizing the big piece of real estate, which is the equity piece, wanting to position myself where I could actually have equity in some of these developments. Shut down my Airbnb arbitrage business just before the pandemic, thank God, because that would have financially broke me. And then transition into commercial real estate, looking at adaptive reuse opportunities. As aforementioned, pursued hotels, started looking at hospitality assets here on the left coast, realizing the price per key was just not making sense, eventually finding opportunities in Florida. As a syndicator, we put together a purchase of not 1, not 2, but 3 hospitality assets that we acquired at around $40,000 a key. These are assets located in Jacksonville, Florida. And we converted 334 keys into 341 studio apartments. And then, with that being said, when it comes to hunting whales, it's always, very glorious to go out there and harpoon a large opportunity. But then it's like, okay, I'm in the middle of the Pacific and I have to drag this to shore. How am I going to do so? And it takes resources, capital, time, and energy. And so started to transition into more transactional opportunities, learning about syndications, but wanting to get into more of a micro syndication type position where, we are now looking at purchasing cash flowing assets, leveraging the seller's equity, as long as the blended interest rate is below the existing cap rate. So we like to call this capital stacking. Some folks call it the Morby Method. I like to call it the Morby Method on steroids, or a combination of the Hatcher method and the Morby method, where we're not recording a subordinate lien. We are actually taking the seller's equity and putting it into an LLC and or a trust, hence the Hatcher method. And we now have come up with what we call the equity carry method, where we're able to preserve the seller's equity, carry it forward, and by doing so, we're capital stacking, thus getting a blended interest rate far below half of what the market is offering, and being able to preserve the seller's equity. As long as that cap rate is high enough, we can cash flow, and we're also over leveraging the acquisition. So not only are we buying real estate, cash flowing assets, both conventional and businesses backed by real estate, but we're doing so by over leveraging. So we're getting paid to buy real estate, and we're also financing not only the purchase or the down payment that we're giving the seller, we're also financing the closing costs and also putting some reserves aside and getting a bit of a capital back at that close of escrow.
So what does the seller get out of the equity carry method? It seems like they're carrying their equity forward. They're providing a low interest rate. They're funding some of these renovations and the carrying costs and the down payment. Very accretive to the buyers. Why would a seller go for something like this? What are some of the benefits that sellers you've worked with have seen so far?
Excellent question. As you probably are well aware, in order to put deals together, as far as an investor's point of view, you're typically coming in with, a cash offer, right? And cash offers, because they are, in essence, not observing any contingencies, you're looking at a quicker close, that usually comes at a steep haircut to the seller. So as an investor, if you're looking to do fix and flips, you're usually going in with a cash offer, call it 70% of the after repair value, minus repairs. If you're a wholesaler, maybe minus an assignment fee. So in most cases, you're presenting a purchase price to the seller at maybe a 40% haircut. And so not a lot of sellers want to sell at such a steep discount. You also have what is called first position seller financing, where if the property owner has no debt and they're not looking to sell at a steep haircut, they may offer terms. So if I can get to your price, I would want terms. And so those terms are typically a lower down payment, because as an investor, you want a decent cash on cash return. So most cases, if you're coming in with, say, first position seller financing, you're coming in with a down payment between, say, 5 and 10%. And then, of course, monthly payments on the seller's equity, or in this case, a recorded first position note. Those payments would have to allow the investor to not only cash flow, but get a decent cash on cash return. Juice has got to be worth the squeeze. But the situation with first position seller financing is most sellers, if they're open to terms, they want a larger down payment, right? The reasons why they're selling are numerous, but in most cases, they want a large influx of capital at the close of escrow. So what we find is when sellers are open to selling with terms, they want a 30, 40, maybe a 50% down payment. Now, with first position seller financing, if I were to come in with my own capital at a 30, 40, 50% down payment, my cash on cash returns are dismal, right? They're basically maybe 1, 2, 3, 4 points. So why don't I not just take that money, dump it into the stock market, make double digit returns, and I'm not dealing with tenants, termites, or toilets, right? So with the equity carry method, what I'm doing is I'm actually financing the seller's down payment with a first position loan. So it's in essence a double close. I can now get to the seller's asking price, in this case, preserve the seller's equity, which they would probably see wiped out if I came in with a cash offer, right, at say 60 cents on the dollar. So they're in essence walking with a offer where 40% of their equity is wiped out. In this case, I'm coming in with a first position loan. I have lenders that have no seasoning or sourcing requirements. So the lender is going to give me a loan, and I typically will come in not at an LTV of the down payment the seller is looking for, but maybe 10 or 15 points above. And this is where I'm able to now over leverage, carry the seller's equity, which is now what I'm preserving. So I can get to the seller's asking price. I can unlock a large down payment for the seller. Now I'm able to capital stack and get a blended interest rate. So in essence, it becomes a win for both buyer and seller. It has certain tax advantages for the seller as well, right? So they're not getting all of their money up front, hence they would have to pay pretty significant capital gains taxes. So they're unlocking a large percentage of a down payment, and they're getting installment payments on their equity. It is shown as a preferred equity structure, similar to a syndication, in this case, a micro syndication. And now I can potentially cash flow by capital stacking that first position loan with the installment payments that I'm giving the seller, thus allowing me to cash flow, get to the seller's asking price, unlock a large percentage of their down payments. Becomes a win-win for both parties. It works for a large percentage of our sellers. And what I'm pitching is 100% legal. Whether the seller invests their equity 6 minutes after the first closing or 6 months down the road, they're in essence taking their equity, investing it into the LLC that's holding title, right? And then I'm taking that equity that has been invested into the LLC. I'm now paying off that transactional lender that allowed me to do that first closing. And, it's a win-win for both parties.
So it allows you, through these creative strategies, to get a little bit more leverage on these deals and close deals at prices that work for the sellers while also working for you, because it allows you to cash flow. Is that kind of the goal? That's the goal.
We're getting a blended interest rate. And by capital stacking, we're engineering inexpensive capital that we're not seeing in today's market.
What is the typical interest rate that you're able to get with these sellers?
That's really an interesting question, because in most cases, because I'm preserving the seller's equity and carrying it forward, I'm actually giving them installment payments only, so principal payments only on their equity. So 0% interest, right? And it's not debt, it's equity. So it doesn't really fall into that IRS rule where they have to have that implied interest on that debt. In this case, it is a preferred equity structure that we're recording in a JV in that second closing with our closing attorney.
Nice. Yeah. Advanced tactics. That's awesome.
Advanced tactics. Yeah. It's definitely college level wholesaling 101. But we're now, I've launched an academy called the Equity Carry Academy, have over 150 students that I'm teaching these advanced creative financing strategies where we can go to market, look at sellers that are sitting at least, call it a 6-7 cap or greater, right? And coming in with saying, hey, if we were to get to your asking price, would you be open to selling with terms? Right. And so it works, quite frequently, actually.
So one reason why many investors aim for 70% of ARV is because that allows the BRRRR investors to come in, do their renovations, cash out, refinance, pull their cash out, infinite return. Woohoo, right? One thing that I could see with the equity carry method or with the Morby method, this capital stacking is, as you mentioned, there's a lot of leverage on the deal. So if you do have a lender that's involved that may have like a 5-1 arm or something like that, something where it's a 5-year term on a mortgage, how does that work on the back end when you go to refinance, if you ever need to?
Yeah, I mean, that's a good question. We typically look at least a minimum of a 5-year balloon, right? So that gives us the opportunity to then balloon the seller out. We will put in potentially a refinance contingency into the PSA. So at that 5-year balloon, if we are not, if we're unable to meet that 75% refinance number, maybe we can extend that out, right? So it really depends on what lending product we get in the first part of that transaction. So, and then we can then determine, do we want to sell at the end of that balloon? Do we want to actually hold? I mean, in essence, we're kind of futuring the seller's price. So it would be more or less a kind of a case-by-case basis.
That makes sense. And with it being a 0% interest, essentially, but it's preferred equity that's getting paid down, that allows you to pay down that principal to the seller as well. That's my understanding. Is Correct. That a pretty substantial portion of how you're able to do these refinances?
Yeah,
or is it mostly appreciation backed? Are you only doing this in certain markets that are getting a lot of appreciation, and maybe it doesn't work in like Midwest markets?
It works pretty much in all markets, but we are conservatively putting like a 3.5% appreciation annualized, right? So, depending on which market you're in, some markets are seeing like a 7 to 10% appreciation, but we are looking to really be conservative with our initial offer. And the reason for, that 5-year minimum balloon is to ensure that we can hit that refinance contingency or hit that refinance position at the time that we're going to balloon the seller out.
And how do you structure that pref equity note, essentially? Is it personally guaranteed? Is it non-recourse? What does that typically look like?
We can PG that, actually put that equity position with the seller. It really will come down to seller motivation, what they're looking for. Again, case by case basis. It really comes down to seller motivation, what they're looking for on price, what terms are comfortable with. But we can add certain recourse measures in place for that JV agreement. Most notably, if we fail to, say, make 2 consecutive payments, we could be, in theory, pushed out of the LLC that's holding title.
Got it. And then it just reverts back to the seller, which they owned it in the first place. So it's kind of a low risk play for them, it sounds like.
Correct.
Okay, cool.
Yeah.
With this, does this work with a lot of different asset classes? Do you typically focus on just multifamily, small multifamily, single families? Like, how do you implement this?
We are all over the books. So I like to diversify my prospecting, and I teach my students to do just the same. Typically with, say, small residential multifamily, 1 to 4 doors, we can get a DSCR lender as much as like 80% LTV, which allows us to substantially over leverage the acquisition, which is giving us pretty substantial cash back at close of escrow. So if we were looking at, say, single family, for example, as you know, if it's an LTR, typical cap rates are fairly low, 3 to 5%, which in most cases would not work with the equity carry method. You need to see a higher cap rate unless you're coming in with a lower down payment. So with my adaptive reuse kind of background, if it comes to, say, SFRs, we're looking at, say, large residential single family homes in highly densely populated markets where we could take, say, a 6-bedroom, 3-bath home and convert it into a pad split. So we've now kind of, engineered a potential higher cap rate, because now we're looking at, say, 6 revenue streams versus 1 as an LTR, traditional rental type scenario. And so by doing so, we can now increase artificially that cap rate by reimagining that property as a pad split and then leverage the equity carry method. With smaller residential multifamily, duplexes, triplexes, 4plexes, you'll finding cap rates are a little higher in the Midwest. So you could go in with kind of like that LTR strategy and not necessarily have to reimagine that property into a co-living facility. As far as larger multifamily, again, cap rate is contingent, but it works really well in RV parks, mobile home parks, car washes, gas stations. I mean, really any asset type, asset class, as long as we have a decent, strong cap rate going in. We're now beginning to kind of pivot and looking at boring businesses backed by real estate, because now we're going in with 20, 25, 30% cap rates, or EBITDAs, as they would call it in the business world. But we're just looking at businesses backed by real estate because it's easily financeable. So what we do is we actually take the business portion, kind of peel that away from the piece of real estate, and we're leveraging the equity carry method on the acquisition of the real estate. We place the real estate in a holding corp, and then we have the operating portion of the business, which is purchasing the business, write a triple net lease back to the holding corp, which allows us to get a DSCR loan, fund the acquisition for the real estate. We're coming in with a down payment of, call it 25% of the overall purchase price or 50% of the real estate value. So this works quite well if it's a boring business backed by real estate in the service related industries, right? And we're coming in, giving the seller anywhere between 20 to 30% down payment, carrying the remaining equity for the real estate and the FF&E forward, as well as the business. So we're basically buying a piece of real estate and getting a free business with it.
Nice.
Freaking genius. Huge.
Yeah,
so we're
awesome.
now like, okay, this is working quite well for SFRs, multifamily car washes, but as I mentioned, the cap rates are like 7, 8, 9%. So why not take the same approach, but look at boring businesses backed by real estate in service related fields that cannot be replaced by artificial intelligence. I think I read something recently where there's like 75 million businesses that are looking to be transacted in the next 3 to 5 years. We have a slew of baby boomers that want to sell. They're in their 70s. They have no succession plan. So their heirs, sons and daughters, want to have nothing to do with the businesses. They want to sell. They would like to see a large down payment. And then with the equity carry method, we can now carry their business as equity forward, give them principal only payments on that business that we're financing and carrying forward. So now the seller is getting a large down payment and installment payments on their equity. So they're realizing that cash flow over the course of, say, a 5, 7, 10-year balloon.
Which has positive tax implications for them.
Oh, immense.
One question I had was, you mentioned it's 25, 30% cap rates in many of these small businesses. That would mean that it would work for a ton of these small businesses because your interest rates are 7, 8%. So if your whole goal is to keep your interest rate below your cap rate, that is now a huge, huge ocean for you to swim in. My question is, with that big of an ocean, how do you whittle it down to a little pond that you're now looking at different businesses in?
Great question. So that I would take a step back and answer that question with my overall long-term exit strategy, which is roll-ups, right? So we're looking at service-related businesses. So that's going to eliminate a large pool of businesses such as restaurants, right? They have a very large failure rate, not interested in that type of business, only interested in businesses backed by real estate. So that eliminates a lot of businesses. Not interested in franchises, so that's going to eliminate a lot of businesses. My sweet spot are businesses between, say, 500,000 and 5 million, backed by real estate, where the real estate and the FF&E is somewhere between 40 to 60% of the overall asking price, right? So that's going to eliminate a lot of businesses. And then, of course, EBITDA's got to be somewhere in that 20 to 30%. So you've seen that I'm now whittling it down to, again, there's a lot of opportunity out there. I'm looking at precision manufacturers, cabinet makers, glass companies, HVAC businesses, plumbing businesses, electrical businesses, the list goes on. But as you can see by those parameters, I'm now able to kind of whittle that down to a select few businesses that I want to pursue. The goal is to find and take down, say, 5 to 10 like businesses in that service related industry, and then roll them up because, private equity is not interested in $500,000 a year in cash flow, but they are interested in, say, $5 million a year in cash flow. So we're acquiring businesses at, like, say, a 3x of their EBITDA plus the real estate. And if that EBITDA is, call it $500,000, and we are able to, say, acquire 10 similar businesses, now we have an EBIT of, call it, $5 million. Well, we can now exit potentially to a private equity firm and sell that portfolio of businesses at a 9 to 12x of the EBITDA, just sell the business, but then hold on to the real estate, kind of similar to like the McDonald's model.
So I want to pivot back to the adaptive reuse, because I know that you've done a lot of that all over the country. Would you just dive into that a little bit more for me? I think you mentioned in IKEA before we started.
Did I mention IKEA before we started? I think, adaptive reuse, an interesting industry to be in, especially if you can buy distressed hospitality assets at, say, $40,000 a key, and multifamily is trading at, say, $150,000 to $190,000 a door, right? You're having to jump through some significant hurdles, right? So with the hospitality to multifamily conversions, when I said I negotiated contingencies largely around getting the entitlements and the rezoning done prior to closing escrow, because I didn't want to buy hotels and then be stuck with underperforming hotels, right? So that is a significant hurdle to overcome, especially with sellers, right? Because that's a long period for them to wait around until we can close escrow. And then you're having to go through, the renovations, the remodeling, adding kitchenettes to each of the hotel rooms, typically in the backside of the restrooms, adding electrical sub panels to accommodate the additional electrical appliances to handle the additional electrical loads. You're running new electrical in some cases. And of course, getting everything sprinklered, because you're changing code from short-term to long-term use. So typical code requirements are that you have to get all these rooms sprinklered. You're talking about, at a minimum 2 years, 2.5 years before you are at that point where you have a multifamily asset. So it's a long runway, but certainly very financially beneficial if you're able to find those select assets and the right seller that is going to accommodate those timelines.
Yeah, and there's a lot of buildings out there, like office space buildings, especially in the past few years, that have just been sitting vacant or not being used for different reasons, whether it be, work from home or just more office jobs not being available. Have you found any creative ways to work with those?
Great question. We started to look at converting office into multifamily. I was actually even kind of looking at maybe putting in like a pod environment. Of course, code requires both natural light and natural air access. So, when you're dealing with office with large floor plates, that becomes a significant hurdle. What do you do with the center of those floor plates? Do you turn that into self-storage? Maybe some type of other potential revenue play. What I found through my pursuit of office being converted into multifamily is, in some cases, it's almost cheaper to literally level the building and start all over again, building an apartment from the ground up, or an apartment building from the ground up, because of the challenges of working within an existing structure, having to retrofit, bring in utilities. The cost per square foot was like 190 to like 200 plus per square foot, where it might be cheaper just to demo the building and then convert and then just do a kind of a ground up apartment building development. I was at a recent networking event in the Bay Area and came across a company that is into modular data centers, where they would actually put together more or less a rack space in a box, as you will. The thought would be potentially converting select office complexes with, say, a single type tenancy scenario into potentially a data center. So that's something that I'm kind of looking into. That could be a possibility. Very challenging to convert office into multifamily and have it pencil. It only works in very select high density metropolitan markets where you're really almost stealing the office building at a significant discount away from the seller. So you'd have to get it for a really, really steep discount for it to pencil to convert it to multifamily.
With the equity carry method, have you encountered any challenges using that? Have you had to adapt your strategy a little bit in using that, or has it been pretty smooth so far?
Oh God, I mean, I can tell you that, when we first started out, I think we were probably, underwriting, incorrectly in some cases, where we were giving the seller too large of a down payment, certain asset types and asset classes lending becomes a little restrictive, especially if you start looking at assets in rural areas. So it was certainly a learning curve through trial and error, just to kind of feel, one, to see if the deal is going to pencil. I think in some cases we were trying to force, opportunities versus letting deals kind of unfold, which is what I teach now. It's like, let's go into this more of as a consultative approach versus as a salesperson approach, where, take off your wholesaling hat, try not to force an opportunity, but try to reveal an opportunity where it makes sense for both buyer and seller. Take more of a conservative approach with your down payments. If the seller is pushing for interest on the equity that they're carrying forward, a lot of cases, sellers were like, wait a minute, I'm just giving you, you're just giving me payments, installment payments or principal payments on your equity. With that, I could loan this money someplace else and make 8, 9, 10, 11 points on that. I'm like, well, equity is a funny thing. It doesn't become real cash until you sell and you've closed and that money is in your account. So, I'm having to walk sellers through the reality of that. If I have to give you a premium on your equity, which is interest, then I'm having to come down on my purchase price, right? Here's your asking price. If I can get to your asking price, the only way this is going to work for us is that we're only giving you principal only payments on your equity, thus allowing us to cash flow. If I'm not cash flowing, then why do I want to buy it? So yeah, definitely a lot of learning curves, a lot of students, wanting to put deals together, putting a lot of time into walking sellers through our underwriting. I like to be fully transparent with the sellers. This is what we're doing. This is why we're doing it. Full transparency. We are over leveraging. Here is why we're over leveraging. What does that look like? Why am I only making principal only payments on your equity? Here's why. We're looking at a blended interest rate so we can get below your existing cap rate. This is how this is going to make sense for us. So by changing our approach and actually going into each opportunity more as more of a consultative approach, we're finding that more deals are coming our way. We're also realizing that the sell cycle on a lot of these deals, when you're presenting that initial offer, is a lot longer than what we were anticipating, right? Because most sellers would love to sell conventionally, right? A straight one close escrow, simple and straightforward. But in some cases, and in a lot of cases, a lot of the stuff out there on the market is overpriced. So, and I know, if you've been on the market, say, over 60 days, every 30 days thereafterwards, you're about 5% overpriced, right? So if you've been on the market for 6 months, you're probably 20 to 30% overpriced based upon what the market's telling you, right? So sometimes we just need to tell sellers, like, or tell our students, like, the seller just needs to bake a little longer in the oven, right? So if they want their price, they have to agree to our terms. If they don't want to agree to our terms, we don't need to buy this, right? We're just looking to buy cash flowing assets, and we're trying to do the seller a favor by preserving their equity, thus futuring their price, which is basically what we're doing.
One element that is really difficult, that I think it's hard to scale and it's hard to move across the country, is operations. And so when you guys are buying these equity carry deals or businesses around the country, how do you go about operating them?
Third-party property management, really. And we will underwrite that into each and every deal. If it's a business backed by real estate, one of those conventional businesses, the first thing that we'll do when we're talking to sellers is like, hey, tell me about your existing staff, right? Who internally would you potentially see stepping into a senior role handling the day-to-day operations, right? So we want to promote someone internally that can handle the day-to-day operations. We have, a sponsorship team that I put together that will break down asset management, break down handling the financials, so on and so forth. But we do want to have someone internal that can handle that day-to-day operational activity. So that's imperative when looking at businesses backed by real estate. And if it's more traditional real estate, we want to ensure that we're underwriting some type of third-party property manager, depending on the asset type, asset class. So if it's a long-term rental, 7 to 8% property management, maybe as much as 10, MTRs, 15% property management. And if it's an STR that we're underwriting, then we're looking at potentially a 20% management fee that we will pencil into our underwriting to ensure that we have someone taking care of the day-to-day operations, so we can be a little more passive. We can acquire businesses without handling the day-to-day operations.
Yeah, 100%. Steven, what is next for you? You've got your real estate agent business going on, you're buying businesses, you've got the rental properties, you're doing the adaptive reuse. Do you see all these things coming together underneath kind of one umbrella? Are you going to pursue one of the sectors more intensely? Kind of what do you see as the next step for yourself?
Great question. I see myself more acquiring businesses backed by real estate. I mean, I'm really attracted to those enormous cap rates, right? And eventually rolling up these businesses and selling them to pref equity. I've yet to been able to do so, but I see that happening in the very near future, especially with the number of acquisition managers we have within the academy. Each student has the ability to actually get equity, common equity in these deals. We are, bringing in credit sponsors. So a lot of these opportunities, I'm buying them with other people's credit. So I have no limitations on scaling or the number of acquisitions we can take down. We're leveraging gators, so there's no limitation for bringing in EMD. So it's definitely a full ecosystem of partners that we've put together within the academy. But I really would love to see rolling up these businesses and selling them to pref equity. That's kind of where I see myself in the future, is taking down businesses backed by real estate, rolling them up, selling them to pref equity, and holding on to the real estate.
And would you just share, before we close out, a little bit more about your academy?
Sure. So it's on School, SKOOL. It's a online-based program. We have basically 3 tiers. You can come on as a basic member, which gives you access to the coaching. We have classes 6 days of the week. Monday through Saturday, we have what is called a cold calling blitz, where I will be calling on opportunities. So you can listen to me call in on opportunities, listen to me communicate with agents and sellers, and how that pitch will go when basically leveraging the equity carry method. We have classes Mondays, Wednesdays, and Friday evenings from 4 to 6 p.m. where I will do deal breakdowns, review underwriting, look at opportunities, answer questions, handle objections. We have a student-led class on Tuesdays and Thursdays where I'm not present, where students can, more advanced students can actually teach new oncoming students. That's basically part of the basic program. We have a premium level, which is basically you get the basic, but also the technology package. The technology package includes our customized CRM, so you can keep basically organized on all of your leads, gives you a website, a branded URL for your email address, and a Google Works place for all of your files. And then, of course, if you wanted to sign up for the entire year, you'd get the premium package, but at a significant discount. Yeah.
Very nice. Well, Steven, thank you for coming on the show. And everyone who's been here, thank you for listening to Capital Conversations. We will catch you next week.
Thanks, AJ.
Thanks.